Hello guys, I hope you're all doing well. In this session today, we are going to be discussing the CA Inter Income Tax RTP for November 2022 examination. Our very first question here in front of us is a case study based MCQ. A very good question focusing entirely on joint development agreements covered in section 45 subsection 5A as well as section 194 IC. Now, these two sections very often get a sort of a stepmotherly treatment from us because we've not seen questions from here in the examination until now. So, a lot of times we as students, we think of skipping these two sections and we do not do them as well as we should have done them. And also, ICI has never, given us any questions from here, nor in the past examinations, nor in the, study material book back. So, and also these two sections are not very, very old sections. So that is why these two sections, I'm very sure most of you wouldn't even be aware that these two sections exist, right? So keeping that in mind, I'll be going a little deeper in our discussion of the very first case scenario, because I'm assuming there would definitely be many students who have no clue about these two sections. All right, so this is going to be a very good learning for all of you. Let's begin. Let's read the question. Let us understand what exactly has happened here, and then we'll get to the questions. All right, let's read. It says, High-Tech Limited, a real estate development company, entered into an agreement with Mr. Sakshar, a resident individual, on 25th June 2019, as per which Mr. Sakshar agrees to transfer a plot of land measuring 12 acres in New Delhi to High-Tech Limited. Mr. Sakshar purchased such land on 14th July 2017 for 80,50,000. So we have two people in our story, High-Tech Limited, which is a real estate development company, and we have Mr. Sakshar, a resident individual. Mr. Sakshar is transferring his land, his vacant land, guys, it's just a land. He's transferring his plot of land to New Tech Limited. Okay, when is he transferring? The agreement was entered into on 25th June 2019, and long back Mr. Sakshar had purchased this land on 14th July 2017 for 80,50,000. High-Tech Limited plans to develop a high-rise society of 250 flats on such land. In consideration, High-Tech Limited paid a part consideration of 1 crore to Mr. Sakshar on the date of agreement and would provide 3 flats in the society to him as final settlement. What has happened here? Try to understand the story. What exactly has happened here? We have two people. We have Mr. Sakshar, and then we have this construction company, this development company, High-Tech Limited. Right? So Mr. Sakshar has transferred his plot of land to High-Tech Limited. High-Tech Limited is going to give Mr. Sakshar rupees 1 crore on the date of agreement. And not only that, the question tells us that High-Tech Limited will give Mr. Sakshar 3 flats in the society, 1 crore rupees cash and 3 flats in the society. Mr. S has transferred a plot of land to High-Tech Limited. High-Tech Limited is a real estate development company. High-Tech Limited is going to develop flats on this land, and out of the flats, 3 flats will be given to Mr. S along with 1 crore rupees. This is a classic case of joint development agreement, which in income tax is often called as specified agreement. Specified agreements, joint development agreements, are those wherein the seller transfers his property to a real estate development company and in return gets a share in the property. Cash consideration may or may not be there, but then the seller definitely gets a share in the property which the real estate development company is going to develop. Same thing has happened here. Mr. Sakshar is a seller. He has sold land to the real estate development company. Whether he's getting money consideration or not, irrelevant. That's secondary. What's more important is High-Tech Limited on this land is going to construct flats, and out of those flats, the seller, Mr. Sakshar, is getting a share. He is getting 3 flats. This is a joint development agreement. So first of all, did you understand how will you identify a specified agreement? How will you identify a joint development agreement? Your assessee, your seller has given a property. He has transferred his property to a real estate development company, and in return, he is getting a share in that same property. On this land, High-Tech Limited is going to construct flats, and out of those flats, High-Tech Limited is going to give 3 flats to the seller. This will help you identify that it is a joint development agreement. All right, now going forward, The certificate of completion of society was issued by the authority on 10th August 2021. So Hitech Limited got the land from Mr. Sakshar. For this land, the date of agreement, what was the date of agreement for transfer of land from Mr. Sakshar to Hitech Limited? 25th June 2019, right? And Mr. Sakshar had purchased this land long ago. He had purchased his land on 14th July 2017 for 80 lakh 50,000 rupees. He got 1 crore on the date of agreement and he's going to get 3 flats. Hitech Limited is going to be constructing how many flats on this land? 250 flats, out of which Hitech Limited is going to be giving 3 flats to Mr. Sakshar. The question says certificate of completion. The construction completion certificate of the society was issued by the authority on 10th August 2021. So Hitech Limited is going to be constructing 250 flats, right? For these 250 flats, the construction completion certificate was given by the authorities on 10th of August 2021. Then what else? On such date, on 10th August 2021, stamp duty value of each flat in the society was 2 crore 51 lakhs. So on this date, the stamp duty value per flat is rupees 2 crore 51 lakhs. Okay. Then what else are they telling us? On 31st August 2021, Mr. Sakshar sold 2 flats in the society to Mr. Kevin. We just saw, right, that Mr. Sakshar was getting 3 flats from Hitech Limited. So out of these 3 flats, he kept only 1 flat and 2 of the flats he sold to Mr. Kevin. For how much did he sell them? For 2 crore 70 lakhs. In return, Mr. Kevin gave him rupees 2 crore 70 lakhs per flat each. So per flat, Kevin gave him 2 crore 70 lakhs. SDV of each flat on that date was 2 crore 98 lakhs. So this was the full value consideration, whereas the stamp duty value of these 2 flats when we are giving to Kevin is 2 crore 98 lakhs. Okay, then during 21-22, Mr. Kevin has earned salary income of 30 lakh 50,000. Then what else are they telling us? Out of the proceeds received on the sale of land, Mr. Sakshar has purchased a house on 8th September 2021 for a consideration of 47 lakhs and he occupied it for his own residence. So Mr. Sakshar, he sold the 2 flats to Kevin, got money and he used this money to purchase another house property. He has purchased another house property on 8th September 2021. On 8th September 2021, he purchased a house property for how much? For 47 lakhs for his own residence, which means this is going to be a self-occupied house property. He has taken a loan of 35 lakhs, 80% of SDV from SBI for purchase of such house, which was sanctioned and disbursed at the interest rate of 12% per annum on 1st July 2021. To buy this house property, he has also borrowed a loan of 35 lakhs. This loan is 80% of SDV. So obviously we will be able to calculate the SDV of the property. Loan is from SBI. The loan is to purchase the house. The loan was sanctioned on 1st July 2021, carrying 12% interest. He does not own any other residential house on the date of sanction of loan. Mr. Kevin and Mr. Sakshar do not opt for section 115 BAC and then they've given us a cost inflation index. I hope the question is clear to us. Yes. The biggest and the most important discussion in this question will be about joint development agreement, also called as specified agreement. I hope you've understood how to spot it. Right? The seller is selling a property. He's selling his immovable property. He's selling his land to Hitech Limited. Now, Hitech Limited on this land is going to be constructing 250 flats. And out of those 250 flats, the seller, Mr. S, is going to be getting a share in those 250 flats. He's going to be getting 3 flats. This is a classic joint development agreement. In specified agreement, the owner for sure gets a share in the new property. The owner, Mr. S, he for sure gets a share in the new property with or without consideration in cash. This 1 crore rupees cash may or may not be receiving, but he does for sure get a consideration in the, he does get a share in the new property for sure. Okay, so and then they've given us a lot of information. They've given us information about the stamp duty value per flat. Out of 3 flats, Mr. Sakshar has sold 2 flats to Kevin and then he has purchased another house property. A lot of information is given to us in the question. Now let us go to the MCQs and let us see what exactly have they asked us. The very first question, what would be the tax, if any, required to be deducted by High-Tech Limited in respect of the agreement entered into with Mr. Sakshar? What would be the tax required to be deducted by High-Tech Limited in respect of agreement entered into with Mr. Sakshar? In simple words, they are asking us just about this contract, the contract between High-Tech Limited and Mr. Sakshar. How much tax should High-Tech Limited deduct? Now, between High-Tech Limited and Mr. Sakshar, there's a joint development agreement. When there's a joint development agreement, Section 194IC applies. I am very sure some of you must be thinking about Section 194IA because transfer of immovable property, right? You must be thinking about 194IA, transfer of immovable property, consideration at least 50 lakh rupees, 1% TDS. You would be thinking about 194IA, but surprise, 194IA is not applicable here. Instead, we will apply Section 194IC. Why is 194IA not applicable here? Because 194IA no doubt applies to transfer of immovable property. But when this transfer is in the form of specified agreement, when this transfer is in the form of a joint development agreement, we apply 194IC. And if we apply 194IC, automatically 194IA becomes not applicable. All right. So under 194IC, what are the rules? 194IC does not have any limit, doesn't talk about any amount. Like for example, 194I says less than 50 lakh, we don't have to deduct tax. Only if it is at least 50 lakhs, only if the consideration is at least 50 lakhs, only then we deduct tax. Deduct tax at what rate? At the rate of 1%, right? There is no such 50 lakh limit or no such limit under 194IC. 194IC simply says that on the cash consideration part, when I say cash consideration, I mean the monetary consideration. On the monetary consideration part, for example, in our question, what's the monetary consideration? 1 crore, right? So 194IC says on the monetary consideration part alone, we will deduct tax, and we will deduct tax at the rate of 10%. That's all. There are no limits here. And when do we deduct tax here? We deduct tax at the time of payment or credit, whichever is earlier. So point number 1, as soon as you see transfer of immovable property, no doubt Section 194IA applies. Section 194IA comes to your mind. But then at the same time, in case it is a joint development agreement or a specified agreement, we do not apply 194IA. Instead, we apply 194IC. 194IC also, remember, applies only on the monetary consideration part, and there are no limits here. Irrespective of the amount, you will deduct tax at the rate of 10%. So, who is giving us this 1 crore rupees? High-Tech Limited. When High-Tech Limited gives us 1 crore rupees, at that time, High-Tech Limited will deduct tax at the rate of 10% on 1 crore. I hope you understood, right? So who will the deductor be here? Under 194IC, the deductor is always the real estate development company. So the real estate development company, at the time of payment or credit, whichever is earlier, when they are paying us a monetary consideration part, or at the time of credit of the monetary consideration part, they will deduct tax at the rate of 10%. Here the monetary consideration part is 1 crore. 10% of this will be 10 lakh rupees. This will be the tax which will be deducted at source by the real estate development company, by High-Tech Limited, against Mr. Sakshar. Understood my very first question here? Yes, so this was our learning on Section 194IC. Specified agreement cases, joint development agreement cases. On the deductor will be the real estate development company. On the monetary consideration part alone, 10% will be deducted at source. Okay, this is it about our very first question. Now let me take, so answer would be 10 lakhs. Now let me take you to the second question. What would be the capital gain in the hands of Mr. Sakshar in respect of the agreement entered into with High-Tech Limited, and in which year it would be taxable? What would be the capital gain in the hands of Mr. Sakshar? See, Mr. Sakshar is transferring his land to High-Tech Limited, and in return he is getting 1 crore and 3 flats. So Mr. S is definitely transferring the land. So for this transfer of land, there will be capital gains in the hands of Mr. Sakshar, guys. Obviously, right? So we will come to the capital gains calculation now. Whenever there is a joint development agreement or a specified agreement, for computation of capital gains, a special section, Section 45 5A should come to your mind. Section 45, subsection 5A should come to your mind. This is applicable to joint development agreements or specified agreements. This section talks about some special points, like for example, whenever there is a specified agreement or a joint development agreement, the date of transfer will be the date on which we transfer the possession to the real estate development company. So the date of transfer will be the date of transfer of possession, all right? But the taxation will not happen immediately. The capital gains will be taxed only in the previous year in which we get the construction completion certificate. So generally what do we do? Generally in the previous year in which we transfer the capital asset, in that year only we do the taxation of the capital gains also, right? So whenever we transfer the capital asset, that's when we tax the capital gains. But in specified agreement cases, in joint development agreement cases, section 45 subsection 5A applies, according to which previous year of transfer will be the previous year in which possession is transferred to the real estate development company, and previous year of taxation will be the previous year in which we get the construction completion certificate from the authority. All right, so keep this in mind, and now let's begin. Whenever you get a capital gains question, you always start with the capital asset being transferred. What is the capital asset being transferred? Which asset is Mr. Sakshar transferring? What is he selling? He's selling a land. So Mr. Sakshar is transferring a plot of land, right? Then what is the next thing you look at? You look at the period of holding. What's a period of holding? When did Mr. Sakshar acquire the property? He acquired the land on 14th July 2017. And when is he transferring the property? I just told you the date of transfer will be the date on which we transfer the possession. Now, what does the question say? Does the question tell us when did we transfer the possession? The question says, Hitech Limited, a real estate development company, entered into an agreement with Mr. Sakshar, a resident individual, on 25th July 2019, as per which Mr. Sakshar agrees to transfer a plot of land measuring 12 acres in New Delhi to Hitech Limited. So while they have clearly not told us the date of transfer of possession, we'll assume that the property was handed over by Mr. Sakshar to Hitech Limited on the date of agreement itself on 25th June 2019. So period of holding will start when he acquired the property on 14th July 2017, and it will end on the date of transfer of possession. That is, it will end on the date on which he handed over the property, the plot of land, to Hitech Limited, which is 25th June 2019. Now, this period, if you see, is definitely less than 12, 24, 36. And what's a relevant period of holding for immovable property? We're talking about land, immovable property. The relevant period of holding will be 24 months, right? And this period is definitely less than 24 months, and therefore it's going to be short-term capital asset. All right. Now, so capital asset, plot of land, period of holding is less than 24 months, short-term capital asset. Now we will start off with the capital gains calculation. We will start the capital gains calculation with full value consideration. Now, for this sale, what did Mr. Sakshar receive? He received 1 crore cash and he received 3 flats. In joint development agreement cases, under section 45(5)(a), the full value consideration will be whatever monetary consideration he's getting, that number plus these flats which he's getting, their stamp duty value on the date of construction completion certificate. New learning, what will be the full value consideration in joint development agreement cases? Whatever monetary consideration Mr. Sakshar is getting, that plus he is getting 3 flats, right? Full value consideration is whatever you're getting. You're getting 1 crore rupees and you're getting 3 flats. 1 crore rupees, fine, we'll take as it is. For the 3 flats, you will have to take the SDV number. SDV number on which date? Remember, SDV number on the date of construction completion certificate, that is on 10th August 2021. SDV per flat is 2 crore 51 lakh on that date. So what is full value consideration? The monetary consideration part, which is going to be 1 crore rupees, and also 3 flats. For 3 flats, you will consider the SDV on the date of construction completion certificate date. So SDV on the CC certificate date is 2 crore 51 lakhs. So 3 flats into 2 crore 51 lakhs, that's going to be 7 crore 53 lakhs. So 7 crore 53 lakhs here and 1 crore of monetary consideration. So total full value consideration is going to be 8 crore 53 lakhs. Okay. From this, no expenses on transfer, straight away I'll go to cost of acquisition. Of course, we will not index the cost of acquisition because the period of holding is less than 24 months. So straight away we'll subtract the cost of acquisition. Long ago, Mr. Sakshar had purchased the property for 80 lakh 50,000. So his cost of acquisition is 80 lakh and 50,000. That leaves us with short-term capital gain of 8 crore 53 lakh minus 80 lakh 50,000, which is 7 crore 72 lakh and 50,000. Please check my math. I hope I'm right. 7 crore 72 lakh and 50,000. This is going to be his short-term capital gain. And this short-term capital gain will be taxed at normal usual slab rates, right? You know, right? STCG may either go under section 111A, special rate, only for listed equity shares, listed units of business trust, listed units of equity-oriented mutual fund, STT paid and all that. But this will obviously not go to 111A. This is immovable property land. This will be taxed under normal usual slab rate. But wait, listen. My assessee sold land and my assessee purchased a house property. Sold land, purchased house property. Does any exemption section come to your mind? Sold land, sold any long-term capital asset other than house property and purchased house property. Section 54F. But can I apply 54F here? I can't, because 54F applies only if we have long-term capital gains. 54F applies only if the capital asset which I'm transferring is any long-term capital asset other than residential house property. This is not a long-term capital asset. This is a short-term capital asset. That is why I'm not even thinking about section 54F. All right, so this is it about our discussion regarding the second subdivision. So what is the capital gain number? Short-term capital gain we just calculated, 7 crore 72 lakh 50,000. But then this capital gains number will be taxed when? It will be taxed only in the previous year in which we received the construction completion certificate. When are we receiving the construction completion certificate? On 10th August 2021, which is going to be previous year 21-22, nothing but assessment year 22-23. So it will be taxed in the year in which we get the construction completion certificate. All right. So that is 7 crore 72 lakh 50,000 in previous year 21-22. One quick revision, two new sections we've spoken about until now, section 194 IC and section 45(5)A. 194 IC and 45(5)A, these two sections always go hand in hand whenever we talk about specified agreements or joint development agreements. First of all, what are joint development agreements? Here, the seller of the property, the transferor of the property, transfers his property to the real estate developer, and in return, he for sure gets a share in the new property. Here, Mr. Sakshar had transferred his immovable property land and he got in return a share in the property, a share in the new property in the form of 3 flats. Monetary consideration may or may not be there. This is how a typical joint development agreement, a typical specified agreement looks like. Then we spoke about section 194 IC. Under section 194 IC, we deduct tax. Who deducts tax? The real estate developer. The real estate developer, when he's giving monetary consideration to the transferor of the property, when High-Tech Limited is giving monetary consideration to the owner of the property, Mr. Sakshar, from this monetary consideration part alone, the real estate developer will deduct tax at what rate? At the rate of 10%, when? At the time of payment or credit, whichever is earlier. There is no amount limit here. Straight away 10% will be deducted, but remember, only on the monetary consideration part. Then for the transferor, for Mr. Sakshar, for the real estate development company, 194 IC, TDS will apply. For the transferor, for Mr. Sakshar, capital gains will arise, because it is as if Mr. Sakshar is transferring his land to the real estate development company, and in return he is getting consideration. A classic transfer this is. 45(5)A says transfer will happen in the year in which we hand over our property to the real estate development company, but these capital gains will be taxed only and only in the year in which the construction completion certificate is received. Right? Then we learned that in such cases, full value consideration is a slightly different calculation. Full value consideration will be whatever monetary consideration we have received plus the stamp duty value of the new property that we are receiving. Stamp duty value on which date? You will take stamp duty value on the date on which we got the construction completion certificate. All right, I've given you a revision of this entire discussion. I hope with this you are crystal clear with our discussion on 45(5)(a) and 194(IC). And one more thing, don't forget, if 194(IC) is applicable, 194(IA) takes a backseat. All right, fine. Now let us go to the third subdivision. Determine the capital gain or loss in the hands of Mr. Sakshar in respect of sale of 2 flats to Mr. Kevin during 21-22. For the purpose of answering this MCQ, assume that no cash consideration was paid by High Tech Limited to Mr. Sakshar. The third question is targeting this transaction. Mr. Sakshar had received 3 flats. Out of the 3 flats, 2 flats he had given to Mr. Kevin, right? They're asking us to calculate capital gains for this transaction. Determine capital gains in the hands of Mr. Sakshar for sale of 2 flats to Kevin. They're saying for this purpose, assume no cash consideration was paid. Assume we actually have this 1 crore cash consideration, right? Which High Tech Limited has given to Mr. Sakshar. They're saying for the third subdivision, assume that there is no monetary consideration. You'll understand this as we work out. Let us go to the third subdivision now. We are calculating capital gains. See, whenever you come to a capital gains question, do not spend too much time, thinking before solving the answer. Because then what happens is you will keep on thinking and the hand won't even move. Read the question and then get to work. I told you even in the last calculation, what is the very first thing you check under capital gains calculation? What is the capital asset? Which capital asset are we talking about? What is Mr. Sakshar transferring? He is transferring 2 flats. Then what's the next thing we check? Period of holding. When did Mr. Sakshar acquire these flats? Read and tell me, when did Mr. Sakshar acquire these flats? When will the period of holding start? The date of acquisition of the 3 flats would be 10th August 2021. Right? That is when the 250 flats were ready. Construction completion certificate came only on 10th August 2021. So that is when the flats were ready, and so that would be the date of acquisition. So Mr. Sakshar got the 2 flats. His period of holding will start on 10th August 2021. And when will it end? When is Mr. Sakshar selling the flats to Kevin? He is selling the flats to Kevin. I didn't put the date here. Let's go to the question and see. Mr. Sakshar here on 31st August 2021. So the date of transfer is 31st August 2021. This period is definitely again less than its immovable property. So 24 months, hardly 20 days. All right. So even this is going to be a short-term capital asset. Now, if I calculate the capital gains, full value consideration, for how much did he sell away the property? See, they say that he sold 2 flats to Kevin for 2 crore 70 lakh per flat, but the stamp duty value is 2 crore 98 lakh. As soon as you see the stamp duty value number, immediately does any concept, does any section come to your mind? Section 50C, right? But you can't straight away blindly apply Section 50C. You'll have to check the criteria, you have to check the conditions. Condition number 1, the transferor should not be a real estate developer. Because if the transferor is real estate developer, then if Mr. Sakshar was a real estate developer, then you would apply 43CA, PGBP and not capital gains. Right? So yes, Mr. Sakshar is not a real estate developer. Then the second condition, you should be transferring land or building or both. Yes, it is immovable property, it is flats. And condition number 3, you should be transferring in such a way that the stamp duty value should be more than 110% of FPC. Right? Now, what is 110% of FPC? FPC is 2 crore 70 lakhs. So 2 crore 70 lakhs into 110% would be 2 crore 97 lakhs. SDV is 2 crore 98 lakhs. SDV is more than 110% of FPC. Hence, we will ignore the actual FPC and instead we will stick to the SDV number. You agree with me, guys? Yes, SDV is more than 110% of a full value consideration. Hence, I will ignore the full value consideration number and I will stick to the SDV number, which is 2 crore 98 lakhs. So 2 flats and each flat SDV is 2 crore 98 lakhs. The total full value consideration is going to be 5 crore 96 lakhs. We do not have any expenses on transfer, so straight away I'll go to cost of acquisition, and cost of acquisition I will not index because it is a short-term capital asset. So straight away I'll subtract cost of acquisition. Now listen, what is the cost of acquisition for these two flats? For how much did Mr. Sakshar acquire these two flats? Mr. Sakshar had received these flats from High-Tech Limited as consideration for transfer of this land. So did Mr. Sakshar directly pay anything to get these flats? Direct consideration? Not really. So in such cases, what 45(5)(a) says is, listen carefully, section 45 subsection 5(a) says, because of joint development agreement, you will be getting a share in the new property, right? This share in the new property, when you transfer later, what will your cost of acquisition be? You go back to the full value consideration. When you sold this land, go back to the full value consideration. What was the full value consideration when you transferred the land? 8 crore 53 lakh. In this 8 crore 53 lakh, what was the share, or what was the SDV number of those two flats? 2 crore 51 lakhs. See, there is a sort of ambiguity in the cost of acquisition calculation. There are two views. One view asks us to consider even the monetary component part. One view asks us to consider even 1 crore part. The first view says 8 crore 53 lakh is for 3 flats. So do proportionate calculation for 2 flats. The other view, the safer view, the view which we would preferably follow for our examination is, we will see in this full value consideration how much is a 2 flats. In this full value consideration, what is a component of 2 flats? Each flat's component is 2 crore 51 lakh. So in this component of 8 crore 53 lakhs, what is the component of the 2 flats? 2 flats into 2 crore 51 lakh. The question itself asks us here to ignore the cash component part. But even if the question had not asked us to ignore the monetary component part, you remember in the question we had read, for this purpose, assume that no cash consideration was paid. So the question is clearly asking us to ignore the monetary consideration part, but still, even if we had not said that, our answer would have still stayed the same. We would have still followed this view. In the full value consideration 8 crore 53 lakhs, what is the component of the 2 flats? Each flat's component is 251 lakhs. So the cost of acquisition will be 2 flats into 2 crore 51 lakh. In simple words, you can straight away take the cost of acquisition as the SDV number on the date of construction completion certificate, right? That's exactly what 2 crore 51 lakh is. It is SDV number on the date on which we got the construction completion certificate. That's how you can simply conclude. I'll repeat again, full value consideration here, there was no confusion. The period of holding also, there was no confusion. It will start when we got the flats, when the flats were ready, and it will end when we transferred it. But what is the cost of acquisition? The confusion arises because what are these 2 flats? These 2 flats are those which we had acquired when we had given up the land under specified agreement. So under the specified agreement, we had received 3 flats. Out of those 3 flats, 2 flats we are selling. So when you received something under specified agreement and you're transferring that later, I'll repeat again, you received something under specified agreement, you received some share in the new property under the specified agreement, and that when you are transferring, you see long back when you had calculated capital gains in the joint development case, in the specified agreement case, when you had calculated the capital gains, at that time in the full value consideration, what was the component of the 2 flats? That component, whatever was a part of the 2 flats in the full value consideration earlier, that FVC part will now become your cost of acquisition. So earlier in FVC, these 2 flats were considered at 251 lakh each. So that full value consideration will now become cost of acquisition. In simple words, these 2 flats, later when you sell, the cost of acquisition will be nothing but the SDV on the construction completion certificate date. When did we get the construction completion certificate? On 10th August 2021. On this date, what was the SDV? 2 crore 51 lakhs. That 2 crore 51 lakh will become your cost of acquisition later when you're selling away the property. So 2 flats into 2 crore 51 lakhs, 5 crore 2 lakhs. This is going to be our cost of acquisition, leaving us with STCG of 90. Oh yeah, obviously 94 lakhs. Got it, guys. Understood. So in simple words, the only confusion here is the cost of acquisition part, right? Cost of acquisition will be nothing but earlier under the specified agreement calculation, what was FPC? FPC will become the cost of acquisition later. So in the FPC, what was the component of the two flats? 251 lakh each. That will become the cost of acquisition. With this, now you are thorough about 45.5A and 194 IC. So what's our answer? SDCG of 94 lakhs. All right. So what are our learnings, guys? Whenever there is a joint development agreement, a specified agreement, two sections will come to your mind: 194 IC TDS section and section 45.5A capital gain section. 194 IC, the deductor will be the real estate development company. They will be the deductor. They will deduct tax at the rate of 10%. They will deduct tax only on the monetary component part. If 194 IC applies, 194 IA will take a backseat. 45.5A, the owner of the property who is transferring his property to the real estate developer, Mr. Sakshar in our example, he will have to calculate capital gains. We'll have to calculate capital gains in his hands. For him, the full value consideration will be nothing but whatever monetary consideration he is getting, that plus SDV of the share in the new property. SDV you will take on the date of construction completion certificate. Right. So for Mr. Sakshar, under specified agreement, under joint development agreement, his full value consideration will be whatever monetary consideration is getting plus whatever is his share in the new property, that share SDV. SDV will be on the date of construction completion certificate. Under 45.5A, the period of holding, the date of transfer will be the date on which we hand over the possession to the real estate development company. But these capital gains will be taxed only in the year in which the real estate developer gets a construction completion certificate. Okay. Then we learned the new share. The share in the new property, it's a joint development agreement. So the buyer will definitely be getting a share in the new property, right? So this share in the new property, this share, if he later transfers, then what will the cost of acquisition be? Cost of acquisition will be nothing but earlier in the full value consideration, what was the component of the share in the new property? Earlier in the full value consideration, how much was the share in the new property? Share in the new property would be this SDV number, right? So this share in the new property, the two flats, later when you transfer, the cost of acquisition will be nothing but what was this component in the full value consideration earlier. So full value consideration earlier will become cost of acquisition later. Full value consideration was a huge number, 8 crore something. In that 8 crore number, what was the component of the two new flats? That will become the cost of acquisition. So FPC number earlier becomes cost of acquisition later. Now I'm guessing whatever gaps you had must have been filled in. Okay, now let us go to the next discussion, the next question. What would be the total income of Mr. Kevin for 21-22? The fourth question, Mr. Kevin's total income. See, first of all, the question said that he's earning salary income. Remember, here it was mentioned here, Mr. Kevin earned salary income of 30,50,000. See, does any adjustment come to your mind? It says salary income 30,50,000. Something should come to your mind. Standard deduction. They do not use the word computed. So obviously the salary number is given to us here is without considering standard deduction. So his gross salary is 30,50,000. Less deduction under section 16. We will deduct standard deduction of 50,000. So Kevin's net taxable salary is going to be 30 lakhs. Okay. Then what are his other incomes? See, Mr. Kevin is buying two flats from Mr. Sakshar. He is paying 2 crore 70 lakhs only, whereas each flat is worth 2 crore 98 lakhs. Does any concept come to your mind? He is acquiring immovable property by paying 2 crore 70 lakhs, whereas their SDV is 2 crore 98 lakhs. Nothing but acquisition of immovable property for inadequate consideration. He has acquired immovable property for inadequate consideration. Hence, IFOS section 56(2)(10) will apply, right? So, acquisition of immovable property for inadequate consideration, that will be our next adjustment here. We will have IFOS, okay? But This is immovable property, guys. 2 flats. Each flat we'll have to calculate separately. You agree with me? Cash gifts, aggregate. Movable gifts for no consideration, aggregate. Movable gifts for inadequate consideration, aggregate. But immovable gifts, whether for no consideration, whether for inadequate consideration, you always calculate separately, right? Do not forget your basics. So that is why each flat separately I will calculate. Even though numbers are same, I will calculate separately just to avoid silly mistakes if possible. All right. Now, this is immovable property for inadequate consideration. I generally ask students to follow 6 simple steps. Same 6 steps I'll put here as well. We will start off with the SDV number. What is the SDV? SDV of each flat. When Kevin received the flats, SDV was 2 crore 98 lakhs. So 2 crore 98 lakhs. Then what is the full value consideration number? How much did he pay? He paid per flat only 2 crore 70 lakhs. So what is the difference? What's a lesser, what is shortfall? How much lesser did he pay? He paid 28 lakh lesser for each property. Okay. Then the standard is always 50,000. We always compare with 50,000 or 10%. 10% of what? Students very often get confused. It's 10% of the consideration number. 10% of full value consideration number, which will be 27 lakhs. So standard or 10% of full value consideration, whichever is higher. So whichever is higher will be 27 lakhs. Now this step 3 should be more than step 6. Step 3 should be more than step 6. Is step 3 more than step 6? Yes, 28 lakh more than 27 lakh, 28 lakh more than 27 lakh. As step 3 is more than step 6, the step 3 number will be taxable. So for Kevin, IFOS will be 28 lakh for flat 1, 28 lakh for flat 2. So total IFOS for Kevin would be 56 lakhs. So now computing his total income, 86 lakhs. Did we follow this? Yes. His total income will be 86 lakhs. Immovable property, inadequate consideration. Each property, I'll do a separate calculation, right? So step 1, SDV. Step 2, full value consideration. Step 3, difference. Step 4, standard, which is always 50,000. That's standard 50,000 or 10% of the full value consideration number, whichever is higher. If step 3 is more than step 6, then step 3 will be fully taxable. 28 lakh is more than 27 lakh, so 28 lakh is fully taxable. If step 3 is less than step 6, then nothing is taxable. If step 3 is more than step 6, then step 3 number is fully taxable. In simple words, guys, if this difference is more than 50,000 or 10% of the consideration, whichever is higher, then this difference is taxable. That's what you must have studied. Same thing I've put in the form of 6 steps to avoid mistakes. So step 3 is more than step 6, hence step 3 is fully taxable. Okay, here the trick is that you got to calculate for each property separately because immovable property. So 86 lakh would be his total income. Which option would this be? Option C. All right, now going to one last question under this case scenario. What would be the total deduction available under relevant provisions of Income Tax Act to Mr. Sakshar for previous year 21-22 in respect of interest on loan taken from SBI? You remember Mr. Sakshar had purchased a house property. To purchase this house property, he had borrowed a loan from SBI. He had borrowed a 35 lakh loan. He had purchased the property for 47 lakhs. He had borrowed a loan for this purchase from SBI. He had borrowed 35 lakh rupees loan. This 35 lakhs was 80% of SDV. The date of sanction of the loan was 1st July 2021 and the interest rate is 12%. So first of all, how much interest has he paid? What is the interest which has accrued? How much interest has he incurred during the year? 1st July, the loan was disbursed. The loan amount is 35 lakhs. 35 lakhs into 12% interest into, only on 1st July he borrowed the loan. That would be only 9 months, right? So if you work this out, the total interest which he has incurred during the year would be 3,15,000. They are asking us what are the total interest reductions which are going to be available for him under relating to interest. See, first of all, it's a self-occupied property. So first of all, we will take deduction under section 24. But under section 24, for a self-occupied property, we have limits, either 30,000 or 2 lakh. We have two limits. Here, we will obviously try to apply the 2 lakh limit because the loan was borrowed on or after 1st April 1999. Then the loan was borrowed for purchase or construction of the property. And let us assume the purchase or the construction was completed within 5 years. In fact, we don't have to assume, it's very clear. We borrowed the loan on 1st July and we have purchased the house on 8th September. In just 2 months, we've purchased the property. We get 5 years time to purchase the property. 5 years from the end of the financial year of borrowing. So all three conditions fulfilled. Condition 1, we borrowed the loan on or after 1st April 1999. Condition 2, we borrowed the loan for purchase or construction of property. And condition number 3, we borrowed the loan and then we finished the construction or we finished the purchase within 5 years from the end of the year of borrowing. All conditions fulfilled, hence the limit will be 2 lakhs. So under section 24 for the self-occupied property, I will take 2 lakh rupees deduction. I still have 1,15,000 interest left, for which I am very sure section 80 EEA would have crossed your mind by now. Let us discuss about section 80 EEA. Here, what's the maximum deduction you get? Here, maximum 1,50,000 is a maximum deduction you get. But for that, the loan should be sanctioned in the period 1st April 2019 to 31st March 2022. Is the loan sanctioned in that period? Is the loan sanctioned from 1st April 2019 to 31st March 2022? Yes. 1st July 2021 is in that period. Then the loan should be borrowed for acquisition of a residential house property. Is he acquiring the loan for residential house property? Yes, own residence. He's going to use the property for own residence. Please remember, 80 EEA is for acquisition of residential house property and not for construction. If you're borrowing a loan for construction, then 80 EEA will not apply. 80 EEA applies only when you're borrowing the loan for acquisition of a residential house property. Acquisition. All right. And you should be borrowing the loan either from a bank or from housing finance company. Yes, we're borrowing from SBI, from a bank. And also the SDV of the property should not exceed 45 lakhs. What is the SDV? They're saying 35 lakhs is 80% of the SDV. So what is 100%? What is the actual SDV then? 35 into 100 by 80, 43.75. So the SDV of the property is 43,75,000, which is within 45 lakhs. All conditions fulfilled, hence I can take a deduction under section 80 EEA. But 80 EEA maximum I can take 1,50,000. But here I will take how much? 3,15,000 only is the interest. 2 lakh I have already enjoyed under section 24. I am still left with only the balance 1,15,000. So what will be the total deduction relating to interest in this question? 2 lakh plus 1,15,000. That's going to be 3,15,000. Got it? So this is it with our very first case scenario. A very good question. You must have had a great learning regarding 194 IC and 45 5A specified for these. Right, 80 EEA conditions. Once again, I'll tell you, listen carefully. You should have borrowed the loan from whom? Either from a bank or from the housing finance company. You should have borrowed the loan when? What is the date of sanction of the loan? See, here, when you talk about 1st April 1999, this is the date of borrowing. But here in 80 EEA, here we talk about the date of sanction of the loan. The date of sanction of the loan should be in the period 1st April 2019 to 31st March 2022. Then the SDV of the property should not exceed 45 lakhs. Then why did you borrow the loan? You should have borrowed the loan to acquire, to purchase, not to construct, to acquire a residential house property. All conditions fulfilled. Maximum deduction under 80 EEA is 1,50,000. All right. So 3,15,000 was our interest. Total 2 lakh we took deduction under section 24. We are still left with 1,15,000. That 1,15,000 we enjoyed under 80 EEA. That is it with our first case scenario. Going to question number 6 now. This is a simple question. Mr. Raj, aged 65 years, is a salaried person. He has taken a life insurance policy on his major son's name on 1st November 2014. Sum assured of the life insurance policy is 16 lakhs and the premium payable is 1 crore 70 lakhs. He has also taken a medical policy of 10 lakhs for self and his wife on 1st November 2021. Medical policy is valid for 5 years. He has paid one-time premium, lump sum premium of 1,80,000. What is the total deduction available to Mr. Raj for assessment year 22-23? I'm very sure just by reading the question, they're asking us the total deduction. You would have already thought about two sections, section 80C and section 80D, right? We're talking about two policies here, a medical policy and a life insurance policy. Now, first of all, my assessee is 65 years old. Just because he is 65 years old, do not conclude he's a senior citizen unless you assume, or the question says he's a resident. The question says Mr. Raj aged 65 years. Yes, he is an individual. Yes, he is at least 60 years. But if you assume he is a resident, only then you can conclude that he is a senior citizen. All right. Point number one. Point number two, he has taken a life insurance policy. Life insurance policy comes to section 80C. Now, under section 80C, you can take a life insurance policy for yourself, spouse, or children, right? See, understand, under section 80C, all your contributions should be in your own name. Only life insurance policy can be for self, spouse, children. PPF can be for self, spouse, and children. And Sukanya Samriddhi scheme, that will be for the benefit of a girl child. But apart from these three things, everything else in section 80C should be in my assessee's own name. What are the three things which can be in others' name? Life insurance policy, then PPF, and Sukanya Samriddhi scheme. When I talk about life insurance policy and PPF, these two can be for self, spouse, children. And when I talk about children, they may be major, minor, dependent, independent, married, unmarried, own, adopted, doesn't matter. So self, spouse, children, here my assessee is paying life insurance premium for his son. His son is major, that doesn't matter. Self, spouse, children, son comes under children, covered. How much premium is he paying? He is paying 1,70,000 premium. But when did he take the policy? He took the policy on 1st November 2014. Does any date come to your mind? He took the policy on or after 1st April 2012. Therefore, the maximum premium that he can pay is 10% of sum assured. So what is the sum assured? 16 lakh. 10% of 16 lakh will be 1,60,000. So even though actually he has paid 1,70,000, I will not consider 1,70,000. I will consider only 1,60,000. But section 80C falls under section 80CCE. 80CCE says section 80C plus section 80CCC plus section 80CCD subsection 1, the total should be less than or equal to 1,50,000, guys. 80C, we already have 1,60,000. We do not have 80CCC or 80CCD1 here. So the total is 1,60,000. We will restrict it to 1,50,000. So at chapter 6A under 80C, we'll get a reduction of 1,50,000 only. You understood this part? Yes, life insurance premium for self, spouse, children allowed. Here we are paying life insurance premium for assessee's son. No doubt the son is a major. That doesn't make any difference to us, right? And also the policy is taken on or after 1st April 2012, which means at the maximum we can pay only 10% of sum assured as premium. That was 1,60,000, which we restricted to 1,50,000. Now talking about 80D, our assessee has taken a medical insurance policy of 10 lakh rupees for self and wife. Under 80D, I'm sure you would be aware that there are two categories. One is the family category and the other is the parents category. Under the family category, you have self, you have spouse and dependent children, right? Under the parents category, dependent or independent doesn't matter. Here my assessee has taken a medical insurance policy for self and spouse, which means we're talking only about the family category. Now, what is the limit? The limit is generally 25,000 in each category. But if my assessee is a senior citizen, then the limit becomes 50,000 per category. Is my assessee a senior citizen? He is an individual. He is at least 60 years. Let's assume he is a resident. So yes, he is a senior citizen. Hence, the limit applicable will be 50,000. But how much premium did he pay? He paid 1,80,000 premium. This was one-time premium. This was lump sum premium which he has paid for 5 years. The policy he took was from 1st November 2021, 5 years. 1st November 2021, he took the policy. The policy will go on for 5 years, which means when will the policy end? The policy will end on 31st October 2026. You agree with me? 5 years from this date, policy will end on 31st October 2026. So period of the policy is 1st November 2021 to 31st October 2026. This period covers how many previous years? This period covers previous year 21, 22. What are the previous years it touches upon? 21, 22, then 22, 23, then 23, 24, 24, 25, 25, 26, and till 31st October 2026, which means even 26, 27. So this period of 5 years is going to touch upon 6 years. So 1,80,000 premium which we paid, lump sum 1,80,000, we will split across these 6 years. So each year we will get 30,000 deduction. 30,000, which is well within the limit of 50,000. So what will our total chapter 6A deduction be now? Our total chapter 6A deduction will be 1,80,000. Please remember, when you pay lump sum premium, you straight away do not divide 1,80,000 by 5. You will see the policy is touching upon how many previous years. Across those previous years, you will distribute the premium. All right, we are paying premium of 1,80,000 and a policy is going to touch upon 5 years. So across 6 years. So across the 6 years period, you will distribute the deduction. So each year 30,000, 30,000, and our maximum limit is 50,000 for 80D deduction, right? Because senior citizen, and 30,000 is well within the 50,000 limit. So 1,50,000 for ATC, ATCCE, and 30,000 for ATD. Total 1,80,000. Answer is here option D. Okay, so this was it about question number 6. Now coming to question number 7, another very interesting question. Let's read the question first. The question says, Mr. Karan completed his MBA in April 2021 and joined XYZ Limited from 1st May 2021. Please notice he is joining only on 1st May. That is April month not considered. His basic salary is 2,25,000 per month. He is paid 12% of basic salary as DA, forming part of retirement benefits. DA is forming part. He contributed 11% of his pay and DA towards RPF. Company also contributes the same amount. Employer's contribution and his contribution both is only 11%, not more than 12%. Hence, employer's contribution part, nothing will be taxable. Accumulated interest on the provident fund is 49,325. This entire interest will be for the current year only, because current year only, just a moment. Current year only he started the employment. So this would definitely be current year's interest only entirely. What would be the income chargeable under the head salaries of Mr. Karan for assessment year 22-23? He does not opt for 115 BAC. They're asking us about the total taxable salary of Mr. Karan. Right? So let's begin. What are his salary components? First of all, we have basic salary. Right? So basic salary is 2,25,000 per month. And how many months will we calculate for? Only 11 months, because he has joined the employment only in May. So for 11 months, 2,25,000 into 11, that will be 24,75,000. Then we have DA. The question says dearness allowances 12%. 12% of basic salary he got as DA. So 24,75,000 is his basic salary. 12% of this works out to 2,97,000. This is his DA. And they are saying the DA is fully forming part. Keep that in mind. He contributed 11% of his pay. His own contribution I will not bother about here, because his own contribution goes to section ATC, right? And they are calculating only salary income. So his own contribution, I will not be bothered about that in the salary calculation. But what is the employer's contribution? 11% of basic and DA. Even the employer's contribution is within 12% of salary. Employer's contribution also is within 12% of basic salary plus DA forming part plus employee's turnover based commission. It is only 11%. So even here, employer's contribution part also will not be taxable. You're aware of this. Employer's contribution, if it is more than 12% of salary, then the excess over and above 12% is taxable under the head salary. Then he gets interest. Interest is 49,325. Here we'll have to do some calculations. See, listen. What is the employer's contribution and what is the employee's contribution? The employer's contribution is 11% of basic and DA. DA is fully forming part, they are saying. See, employer's contribution will be basic 24,75,000 plus DA 2,97,000 into 11%, right? So 3,04,920 the employer is contributing. And what is the employee's contribution? Even the employee is contributing 3,04,920. So what's the total money in the RPF account of my assessee? 6,09,840. On 6,09,840, he has earned interest of how much? Interest of 49,325. So can you calculate what is the percentage of this interest? 49,325 interest he has earned on 6,09,840 contribution. So what is the percentage of interest? 49,325 divided by 6,09,840 into 100, right? How much will that work out to? Calculate. That will work out to 8.09%. So his interest is within 9.5%. Hence, even for the interest component, nothing is taxable. You agree with me? So employer's contribution is within 12% of salary. Employee's contribution, anyways, we don't consider in the salary calculation. We consider that only in ETC. And even interest is within 9.5% and hence nothing is taxable. But then, we can't stop our discussion here. We have two more concepts which we should be thinking about. If the employer's contribution to RPF plus NPS plus superannuation fund is more than 7,50,000, then the excess over and above 7,50,000 gets taxed as perquisite. But here, employer's contribution, first of all, we have only RPF. We don't have NPS. We don't have superannuation fund. And the employer's contribution is only 3,04,920 within 7,50,000. So this provision will not apply, guys. Right? You recall this provision, I hope? Yes. If the employer's contribution to these three put together is more than 7,50,000, then the excess over and above 7,50,000, we tax as perquisite. Right? Here it is not more than 7,50,000. It's only 3,04,920 employer's contribution. So nothing is taxable under this provision. Then, in case the employee's contribution is more than 2,50,000, then on the excess contribution, whatever interest he earns, that interest will be taxable under the head salaries. You agree with me? If the employee's contribution, if this number is more than 2,50,000, then on the excess, whatever interest he has earned, that will be taxable under the head salaries, right? In case there is no employer's contribution, then instead of 2,50,000, you compare with the number 5 lakhs. You're aware of it. Is this provision applicable here? Clearly, yes, it is. Employee's contribution is 3,04,920. The employee's contribution is more than 2,50,000. So what is the excess? 3,04,920 minus 2,50,000. The excess is 54,920. On this 54,920, how much interest has my assessee earned? See, my assessee has earned 49,325 interest on 6,09,840. So, on 54,920, how much interest he would have earned on just this excess? On simple proportionate calculation I'm going to be doing, he has earned 49,325 interest on 6,09,840. How much interest has he earned on 54,920? So if you cross multiply, that's going to leave you with the number 4,442. This is the interest on this excess. This interest on the excess will be taxable under the head salaries. So this is nothing but interest on employees' contribution exceeding 2,50,000. So exceeding 2,50,000, what is the excess? Excess is 54,920. On this 54,920, how much interest has he earned? On 6,09,840, he has earned 49,325 interest. On 54,920, how much interest has he earned? Simple cross multiplication. That's going to be 4,442. No other income. So now if you add up, what is the gross salary of our assessee? His gross salary will be 27,76,442 minus standard deduction 50,000. No professional tax, no entertainment allowance. So his net taxable salary will be 27,26,442. 27,26,442. This will be his taxable salary. Here, option A, 27,26,442. The only important thing that we would have learned through this question is this part, right? In case the employee's contribution is more than 2,50,000, then on the excess, over and above 2,50,000, how much has he contributed? On this excess, whatever interest he has earned, even this interest will be taxable under the head salaries. All right, so this was it with question number 7. Now let's go to the next question, question number 8, another interesting question. This question will also bring into picture 115 BAC. Let's read the question and then we'll work it out. Question number 8. Mrs. Kajal, the general manager of Messrs Gold Limited, was paid a salary of 4,50,000 per month. The above salary includes non-monetary perquisite of 50,000 rupees per month. As per the terms of employment, tax on non-monetary perquisite is to be borne by Messrs Gold Limited. So tax on non-monetary perquisite, employer will be bearing. Mrs. Kajal's contribution towards PPF is 1,50,000. What would be the amount of tax to be deducted by Messrs Gold Limited from the salary of Mrs. Kajal if she intimated Messrs Gold Limited to opt for the provisions of 115 BAC for assessment year 22-23? In this question, we have two people in the story. We have Messrs Gold Limited and we have this lady, Mrs. Kajal. Kajal is the employee and Gold Limited is the employer. Gold Limited is giving Kajal 4,50,000 per month salary. This salary includes 50,000 per month of non-monetary perquisites. Non-monetary perquisite of 50,000 per month. So this 4,50,000 is nothing but 4 lakh plus 50,000 every month she is getting. This 50,000 is nothing but the non-monetary perquisite part. Now, the employer is giving salary to the employee. They're asking how much TDS should the employer deduct. Obviously, TDS on salary, which section comes to your mind? Section 192 will come to your mind. Section 192 deducts tax on the basis of normal usual slab rates, but if the employee informs employer that he is going to follow section 115 BAC, then applying 115 BAC, the tax will be calculated. So Kajal has informed Gold Limited that she wants to follow 115 BAC, the concessional tax rate section. So that's what we will apply. Then the question also says that Mrs. Kajal's contribution towards PPF is 1,50,000. She is contributing towards PPF 1,50,000. Which section comes to your mind? Section 80C. Also the number is well within the 1,50,000 limit. The question also says tax on non-monetary perquisites will be borne by the employer. I hope you recall the provision tax on non-monetary perquisite. If it is being borne by the employer, then what's the tax treatment? See, for the employer, this is definitely a business expense, right? Because employer is paying employees tax. But this business expense is disallowed for the employer. For the employee, definitely this is a benefit because the employee does not have to pay this tax. This tax is being taken care of by the employer. He can escape the payment of this tax. It is definitely a benefit which he is enjoying because of his employment, but this benefit is going to be exempt for the employee. Right? So tax on non-monetary perquisites paid by the employer. For the employer, it's a business expense and it will be disallowed. For the employee, it's a benefit, no doubt, but this benefit will be exempt. Okay, keeping all this in our mind, we are going to be calculating our assessee's total income and assessee's tax liability because The question is asking us about Section 192 TDS. What is the amount of tax to be deducted by Gold Limited? So how do you calculate Section 192 TDS? You need to know the tax liability of the employee. That is the amount, whatever is the tax liability of the employee applying the slab rates, that is the amount which the employer deducts at source under Section 192. So when the employer calculates Kajal's salary income, how will the employer calculate? His salary income, he would say, is 4,50,000 per month. So 4,50,000 into 12, 54 lakhs. Yes, this includes non-monetary perquisite also. Of course, it should include non-monetary perquisites because non-monetary perquisites are anyways taxable. The only tax on non-monetary perquisite is paid by employer. Only the tax part will be exempt. But non-monetary perquisites will anyways be taxable for the employee. So 54 lakhs is his salary. And from salary, generally, what do we deduct? Standard deduction of 50,000, which we will not deduct because my employee wants to follow 115 BAC. If you follow 115 BAC, you don't get standard deduction. So my assessee's taxable salary will be 54 lakhs. You also get Section 80C deduction from the total income, but even that my assessee will not be able to enjoy because under 115 BAC, 80C deduction also you do not get. Under 115 BAC, the only Chapter 60 deductions you get is 80 JJAA and 80 CCD subsection 2. So even 80C you will not get. So the total income of my assessee is going to be 54 lakhs according to the employer's calculations. Until here, clear, right? So Gold Limited is going to pay Kajal 4,50,000 salary every month, which includes 50,000 of non-monetary perquisite. Tax on non-monetary perquisite employer is bearing. So employee's total income will not include the tax part because even though it's a benefit for the employee, it is exempt for the employee, right? So the employee's total income will be 54 lakhs. We applied 115 BAC. We did not provide standard deduction. Also, we did not provide Section 80C. On this 54 lakhs, how will we calculate tax liability now? See, we're talking about Section 192 TDS. So we'll have to calculate tax liability according to the slab rates. We'll have to apply 115 BAC slabs. How do you calculate? Up to 2,50,000 nil. By the way, I hope you know 115 BAC basic exemption limit is always 2,50,000. Even for senior citizens, super senior citizens, it will still be 2,50,000 only in 115 BAC. Right? Then from if the income is more than 2,50,000 up to 5 lakh, in between we have 2,50,000 income on this 5%, right? That's going to be 12,500. Then 5 lakh to 7,50,000, in between we have 2,50,000 income on this 10%, that's going to be 25,000. Then 7,50,000 to 10 lakh, in between we have 2,50,000 income on this 15%, that's going to be 37,500. Then 10 lakh to 12,50,000, in between we have another 2,50,000 income on this 20%, that's going to be 50,000. Then 12,50,000 to 15 lakh, in between another 2,50,000 income we have on that 25% will be 62,500. And finally, exceeding 50 lakh, in excess of 15 lakh, how much income do we have? 54 lakh minus 15 lakh, in excess of 15 lakh, we have 39 lakh income. On that 30% tax rate would be 11,70,000. So if you add up, the total basic tax according to 115 BAC would be 13,57,500. Do we all get this number? Yes. Now, if you look at the total income of your assessee, it is more than 50 lakhs. So, which means we will not have any rebate, right? Because total income is more than 5 lakhs. So, we will not have any rebate. But will we have surcharge? More than 50 lakh up to 1 crore, 10% surcharge, right? So surcharge is always a percentage of tax. Do not forget that. Surcharge is always a percentage of tax. So 13,57,500 into 10%. More than 50 lakh up to 1 crore, 10% surcharge. That's going to be 1,35,750. So total tax will be 14,93,000 250. Whenever we talk about surcharge, we also talk about marginal relief. You can calculate and see you will not have any marginal relief here because total income is 54 lakhs and the limit is 50 lakhs. There is quite a lot of difference. There's a difference of 4 lakhs. You will not have marginal relief. If you want, you can even calculate and check. Then we will straight away add cess at the rate of 4%, 4% of our tax number. That will be 59,730. So if you add up, the total tax liability of our assessee will be 15,52,980. Okay, this is the total tax liability of our assessee. But then guys, on non-monetary perquisites part, on that part, employer is taking care of the tax liability. He is paying the tax. So to that extent, employee does not pay. So to that extent, we don't have to deduct tax also. So 50,000 rupees is a non-monetary perquisites per month, right? That's what we read in the question. Every month, his non-monetary perquisite is 50,000. So 50,000 into 12, 6 lakhs. My assessee's total income is, just a moment. Yeah, so my assessee's total income in the question was 54 lakhs. Right? So for 54 lakhs of income, his tax was 15,52,980, we just calculated. But on the non-monetary perquisites part, on this part, what is the tax? That part of the tax, the employer itself will bear. So to that extent, employee doesn't have to pay. To that extent, even tax should not be deducted then. So if you cross multiply, what is the tax on non-monetary perquisites part? So less tax on non-monetary perquisites. Why are we subtracting this? Because this is going to be borne by employer in the question. How will we calculate? This is the tax that you've calculated for 54 lakhs income. So for 6 lakhs income, what will be the tax? Simple cross multiplication, guys. 15,52,980 divided by 54 lakh into 6 lakhs. That's going to be 1,72,553. Okay, so now if you find the net number is going to be 13,80,427. This is the amount which the employer will deduct at source. 13,80,427. Which option? The first option. Right? So what this question tests us is just our knowledge on the non-monetary perquisites part. The tax on non-monetary perquisites part is borne by the employer. To that extent, employee doesn't have to pay tax. It definitely becomes a benefit for the employee. But that benefit is not taxable for the employee. That benefit is exempt for the employee. So we are calculating section 192 TDS. For 192 TDS, we calculate the total tax liability of the employee. That is the amount which the employer deducts across the year. So that when you calculate the total tax liability, here, from the total tax liability, I will subtract the tax on the non-monetary perquisites part, because on this part of his income, on this non-monetary perquisites part of his income, the tax will be paid by the employer. So the employer is going to be paying 1,72,553. I'll subtract that, and the balance amount of tax the employee will have to pay. So to this extent, TDS will be deducted, tax will be deducted by the employer. Under section 192, at the time of payment of salary, we deduct tax at source. Did you follow this? Yes, I hope you understood the non-monetary perquisites part. Non-monetary perquisites will be a part of his income. This 50,000 into 12 will be a part of his income. Just tax on this part employer is bearing. That is also a benefit for the employee, but that alone will not be taxed for the employee. And to that extent, because employer is bearing the tax, to that extent, to 1,72,553, to that extent, employee doesn't have to pay tax. You understood how we calculated this number? Yes, 15,52,980 was your tax liability for entire 54 lakh of income. Your income was 54 lakhs, right? For 54 lakhs of income, your tax liability was 15,52,980. We are thinking about just a non-monetary perquisites part, 6 lakhs. On this part, tax will be borne by the employer. So how much tax will be borne by the employer if you cross multiply 6 lakh into 15 lakh 50 to 980 by 54 lakhs, 1 lakh 70 to 553 will be borne by the employer. So to that extent, employee does not have to pay tax. Got it? So this was it about question number 8. With this, our MCQs come to an end. The rest of the discussion under your RTP will all be computation questions. Computation questions we will take up in the next video. Thank you, guys. By the way, before I close, let me tell you all, this sheet where I've done all the workings, I'll put a link to that sheet, all right, in the description box. You can download this notebook from there. All right. And in case you guys have any doubts, hit me up with your doubts on WhatsApp on this number. Then will I ever learn to write my 8? All right. Fine. So we'll meet again in the next session where I'll take up the descriptive questions. Thank you guys. Bye-bye.